Hi, everybody, and welcome to Chapter 13. I think for MBA students, this is one of the more important chapters because we're going to now analyze the financial statements that you've so diligently learned how to prepare. Let's take a look at that. Okay, so the objectives we're going to take a look at in this chapter include horizontal analysis, vertical analysis, and ratio analysis as our procedural objectives. And we will take a little more at the building blocks of analysis and how we compare companies in this process. Okay, we're going to define the building blocks of analysis and the standards for comparison here. Now, what we're trying to do is have a common goal of financial statement analysis for both our external and internal users in evaluating companies' performance and financial conditions. And in some cases, those are small companies, in some cases, big companies, and some cases in different industries. So we're going to take a look at past and current performance and what that means, and what their current financial position is, as well as an estimate or a projection of future performance and, of course, the risk associated with that performance. Again, our internal users, which we'll get more into in managerial accounting, include managers, officers, internal auditors, as well as our external auditors for that matter too. Our external users include our shareholders, lenders, and suppliers. I was in error, not the external auditors. The external auditors are external users. Okay, building blocks of analysis. Here we have divided them into 4 categories: liquidity and efficiency, solvency, profitability, and market prospects. I particularly like the way this textbook breaks these down because I think it follows naturally how we would use this information. So let's take a look. What do we need to do that? Well, of course, we're going to need our financial statements. Those include the income statement, balance sheet, statement of stockholders' equity, statement of cash flows. But also don't forget the notes to the financial statements. That is important information for analysis as well. So what are our standards for comparison? Let's say we had a company that had a current ratio of 2.5, let's say. We'll find out about that. Is it good? Is it bad? How do we put that in perspective? Well, we use intra-company. We can look and see how that is done over time. With other benchmarks or standards include competitors and what they're doing in our same industry. And maybe we have industry comparisons and guidelines as well to take a look at. So let's see. Our tools, as I mentioned earlier, include horizontal analysis. That's where we're going to compare financial condition and performance across time, and hence the name horizontal analysis because it's across time. Vertical analysis is where we're comparing that financial condition and performance to a base amount, and you'll see easily how that works. We've had some ratios and other metrics along the way, but here we'll take a look at maybe putting those together in a little more depth. Here we're measuring the key relationships between our financial statement items. All right, we'll start out with horizontal analysis and try to explain how that works and how we apply that. Again, horizontal analysis is the review of financial statement across time. So we're going to look at computing a dollar change. Sometimes in business we call that delta dollars. Delta meaning the Greek for it's like a triangle, and that delta means change. So we're going to look at the analysis period and subtract the base period. That looks a little more complicated than it really is. This is really quite easy to do. When we measure the amount of the change in dollar amounts, we're going to compare the analysis period to the base period. That's important. The analysis period refers to the financial statements under the analysis. And then the base period refers to previous financial statements used for comparisons. So, don't be daunted. This is pretty easy. So what we were going to do, we're going to compute the percentage change, and we divide that change. That's the analysis period minus the base period amount, and then we're going to divide that by the base period amount. Multiply it by 100 to get the percentage. So, when we calculate the change as a percentage, we're going to divide the amount of the dollar change by the base period amount, and then multiply by 100 to convert it to percentage. So, I've said it twice. Now, here's our four cases. So, we have case A, B, C, and D. Here, our base period was a negative 4,500, but our analysis period was 1,500. So the dollar change is 6,000. So that's quite an improvement. Here we have a negative analysis period of $1,000, but the base period was 2,000. That comes out to a negative $3,000 change. And then in scenario C, case C, we have $8,000 on the analysis period, but we had no frame of comparison, or we had 0 in the base period, and that gives us a change of 8,000. So in the base period it was 10,000, and in the analysis period it was 0. They're calling that a $10,000 or 100% decline. Let's take a look. So, if we look at Apple's balance sheet here, here's our current period, here's our prior period. So here, we're going to take the difference between current period, we're going to subtract the prior period, and that gives us a dollar change of $22,931. We're going to divide that $22,931 by the prior year. And when we divide 22,931 by 25,913, we get the percentage change of 88.5% here. Okay, so we're improving in this particular comparison. Now we do that for all the items on the balance sheet. You'll notice that when we do this, our assets have declined in total, and that means our stockholders' equity and liabilities have also declined by that same percentage, as you can see. So we can see specifically where the problems have occurred. And so let's take a look at that. Now, the income statement, here, this is a horizontal analysis now, not a vertical analysis, and that's very easy to get confused. So here, we're comparing our prior year with our current year. And our current year is worse than our prior year by $5,421, representing a 2% decline in net sales. And we run that through, our cost of goods sold went down in the current year, and that's, in this case, that's good. And then our gross margin went down by 3.4%. Okay. So as you see, as it works down the to net income fell by 7.2%. Largely as the result of operating income here going down by 9.8%, and that's because our research and development and selling and administrative expenses went up so dramatically. Okay. One thing I want to point out before I forget, here it shows basic earnings per share and diluted earnings per share. Essentially, basic earnings per share is net income less preferred stock dividends, which are not available to common stockholders. So we're trying to compute the net income available to common stockholders and then divide that through by the outstanding shares. That gives us our basic earnings per share. That's the one I'm always interested in. Diluted earnings per share is also required to be put on the income statement, but it reflects the fact that certain derivatives have been cashed in, pretending to be cashed in, I should say, and that will somewhat reduce the earnings per share if those derivatives were in fact cashed in. So now we have a trend analysis potential. Here we're going to look at patterns across periods. So the base period, then, we'll take a look at that in a minute. We'll just start with the analysis period divided by the base period times 1,000. So let's take a look. Here are our net sales, cost of sales, and operating expenses. And it's very difficult to look at these numbers and make any sense of it, right? So what we do is we use the number reported 4 years ago and set that equal to 100%. And then we express everything as a percentage of that 4 years ago column. Now it starts to make a little more sense. Here, our net sales in the current year went up 11.3%. That's good. Cost of sales, however, went up 115.5% over the 100% 4 years ago, or 15.5%. That's not as good. And operating expenses skyrocketed by 54%. So now we can look at that and say, ooh, this company's having some difficulties controlling costs. And explain, of course, the next step would be to explain why. And here, this line graph of trend percentages shows exactly what happened here. Here's our operating expenses going way up, and our cost of goods sold generally mirroring net sales as it typically does, but you can see there a little bit worse than our net sales. Now, to put that in perspective, here are our competitors, Apple, Google, and Samsung. And we can kind of compare ourselves over time and see how we do. If we're Apple, we could say, okay, how are we doing in the way of revenues? Well, Google's doing much better. Whereas in the current year, Samsung and Google, or Samsung and Apple are about the same. Well, that looks like a good place to stop this video. And when we come back, we'll take a look at vertical analysis. Until then, bye for now.